The stock market fallout since the White House tariffs announcement last week continues. This morning, Wall Street's so-called fear gauge, the CBOE volatility index, surged to the 50 level. On Friday, it closed above 40, its highest closing level in 5 years. Is this temporary pain for long-term gain, or is there more to brace for? Here now to unpack this is financial advisor David Bahnsen. He's a founder of the private wealth group from the Bahnsen Group. He is also the senior fellow of economics for the Center for Cultural Leadership. David, welcome to Washington Watch. Thanks so much for joining us today.
Thanks for having me, Tony.
All right, so been a pretty rough week since the president announced these tariffs, and it doesn't appear that it's over yet.
No, when you get this kind of economic scare, there can be some volatility that's quite prolonged. It's really more than just markets. You definitely have risk assets that have sold off substantially, and yet there's also the bigger fear as to what ends up happening in the economy and where the fundamentals will be throughout the second quarter and going into the third quarter of this year.
Is this possibly Wall Street, big business, kind of bowing up to the president, saying we're not going to go along with this, we're going to show you and we're going to rattle the stock market?
No, I've heard some theories like that, and I would tell you and our listeners out of hand that isn't what's happening here. Wall Street is really a euphemism for capital markets. It's people who have investments in all different aspects of risk assets, from debt to equity, stocks, bonds, real estate, private companies, big companies, small companies. When we're talking about the stock market, you have a substantial amount of the market owned by individual retirees, by pension funds, by a lot of small investors, but then there's also big hedge funds as well. The idea that investors are willing to go sell things at a loss and sell into a loss to try to teach the administration a lesson, I don't think it speaks to a good understanding of what these guys' incentives really are. This is capital in pursuit of a return, not a particular agenda. It's capital being driven by fear right now, Tony, that perhaps we're going to see a decline in profits, a decline in wages, a decline in economic growth. And so from my vantage point, running over $7 billion wealth management firm, I get to see the optics to both the stock market, but also regular business, because so many of our clients are business owners. And I got 100 calls on Thursday, Friday, and over the weekend, 83% of whom voted for President Trump, absolutely petrified about what these tariffs represent to their business and concern for their outlook in the months ahead. So I think it's both a stock market and a real economy and small business impact that right now there's just a lot of uncertainty.
So David, let's talk a little bit about fear for a moment. And I want to put this in a broader context than just economic fear, although that's obviously what we're focused on right now. But fear is something we've been warned against, and there's a reason for that. And I step back to use an analogy with the economy, where we have the consumer price and the consumer confidence index. We look to see what the confidence level is of consumers. Is not our economy built a lot just on confidence and trust? And when there's fear, can that not fuel kind of a stampede?
Well, on one hand, my answer is yes, it can. But on the other hand, it's not, to me, about the consumer. It's about the producer. And this is something that's very important to me theologically, but also economically. I think the self-fulfilling prophecy you get, where when there's a lot of fear, you end up not having a certain activity, is not that people get afraid and say, I'm not going to go to the mall. Candidly, if people are really afraid of their job right now, they shouldn't be going to the mall. Where you get a self-fulfilling prophecy is when there's a decline in production, a decline in capital goods, a decline in capital investment that make and build and do the things that lead to real economic output. Consumption takes away wealth. With this idea that our economy is built on people spending money is just not true. Our economy is built on us producing things. Now, of course, we produce things so people will enjoy them, but it becomes wealth additive. And it's the most important Christian tenet in all of economics. Our belief in economics is one of addition and multiplication. Be fruitful, multiply, fill the earth. That's what Christians believe in about the economy. The Keynesian notion, the statist notion, the central planning idea from the 20th century was an economics of subtraction. And this idea that mankind is just built to go spend money and gratify themselves, and that's where you get economic growth, it's just not true. So I really believe that the fear issue is true, but it's more on the production side than consumption.
Yeah, and when we look at that consumption side, that's also what is driving our idea that the world's overpopulated, and this idea that we don't need children is because they're consumers rather than producers. So when you have this uncertainty, what it does cause are those who would invest money in capital projects are going to sit on that money out of fear of the unknown. Is that an accurate assessment?
They're going to sit on it, they're going to delay, they're going to cancel, they might diminish, like they were going to do something that was a 10 and now they're going to do a 5. There's all those types of things. And so then that leads to a sort of self-fulfilling prophecy of a downturn in economic activity and growth.
But you would agree, I think, that America needs to once again become more of a producer when we've seen a lot of our manufacturing has moved offshore, moved south. Is this the way to get it back? Through the tariffs mechanism?
Well, let's start with what we can't manufacture onshore. Coffee, bananas, certain spices and consumer goods. You know, Adam Smith, the great Christian economist of the 18th century who wrote The Wealth of Nations, taught us that there is a comparative advantage sometimes that makes nations wealthier by trading with one another. Now, you start bringing up communist China, we start looking at some of the more complexity of globalization and offshoring, and I'm not suggesting that all of that fits into the category I use with coffee and bananas. But that's one of my criticisms of the current policy, is it equally paints with a broad brush. I think we have to distinguish between what we're doing to really bring certain productive activities onshore that America can competitively do, and not punishing in those areas where we simply can't. You know, we're going to get better chocolate from Switzerland, right? I mean, so there's certain advantages that we can't get rid of. But the other factor, Tony, is even where there are issues, like certain auto parts manufacturing that over a long period of time went down to Mexico, it can't come back to America in 1 month. These are going to take years to rebuild and re-prep factories. Most of our manufacturing, our job market, is tailored to more high-tech manufacturing. So I don't think that we've gone about it the right way to really carefully analyze what America's strengths are, where we need to invest to the future. And I really believe we have to understand that our labor force, we need more able-bodied men that want to work. And they talk all the time like our only problem is a decline of jobs. But we had a decline of workers. And those are two different things.
Well, not only a decline of workers, but a decline of skilled workers. When you look at what we're training, I mean, we just been in the process of building a house. You know, when you look for bricklayers, you know, we're not training people to do that anymore. That's why there's so many people coming into this country to provide that manual labor, which is a technical skill. I mean, you want your house to stand up when it's built. So there is multiple factors, I agree with you, that comes into this. That said, David, what would be your advice in how this should have been approached as a policy decision?
Well, I would have separated China from the rest of the world. I think not only just politically was there already a little more acceptance that we're dealing with something adversarial with China, and I think that the president did go about treating our friends and our foes the same. And I think that was personally a mistake, both economically and politically. But again, this economic idea that we are being ripped off or being stolen from merely because other countries sell us more things than we sell them, I think that's problematic. I think we need to approach it by looking at China for their particular issues and how we want to solve. A lot of it, by the way, could be getting it out of China now to South Korea, Mexico, Vietnam, and then over time looking for things that can come back to America. But ultimately, I think they painted with too broad a brush. And then they said they wanted to do it on fairness and reciprocity, and they didn't. They ended up doing it more on just who simply sells us more than we sell them. And that's why countries like Vietnam, Switzerland, and South Korea are being punished the most when they don't have barely any tariffs on us at all.
Yeah, well, I definitely agree on China, and it's hard to compete with someone using slave labor. Which they do in many cases, but I think moving it to other countries as an interim before it comes back to our shores is a good idea. So let's talk. We have just about 3.5 minutes left, David. I want to talk practically here. Other than having to pay more for bananas, how should people be prepared for what's ahead?
Well, I still, even though I am critical of this particular administration policy, I still hold out confidence that President Trump has been a very good negotiator throughout his career. He has a style that's very different than mine, and I think right now the risk-reward of this negotiation is very frightening. But I do hope that we get to a place where we get some better deals, but we back off from some of the more problematic elements. I think people should be prepared for some higher prices. And I think people have to understand that even if we get better trade deals in the next month or so, you're going to see a decline in the economy here over the next quarter or two for the reasons you and I talked about earlier, companies that have already pulled back on certain activities. So I would expect a bit of a slowdown, and I'm continuing to pray for wisdom in the administration. He happens to have a lot of advisors around him that I like, and he happens to have a few advisors I don't care for. So I would be praying for the advisors that I like to win the argument.
I do think the president, and I've of course known him since his first term and watched him, and he's made some decisions and taken actions that I just thought, oh, this is the end. He just pulled the pin. When in fact, it turns out this is a way of his negotiations where it's kind of shock, getting people's attention. And in most cases, he's able to work out a good deal. So I still remain optimistic, although when you look at as you pointed out at the beginning of this discussion, how much capital has been lost in the stock market, there's a lot of ground to retake.
There's a lot of ground to retake, and just remember in 2018, he did it in his second year after in the first year. They had built the political capital and economic capital of passing tax reform. And I think the sequence this time was probably backwards from what they did before and had success with. They may have been better off getting the tax reform done first, letting DOGE do some effective things with deregulation and cost saving first, then approaching this more complicated tariff issue. And I would have done the tariff issue by putting the warning out to countries first and having all those meetings, then coming back. But again, to your point, he prefers shock and awe negotiations, so it's just a stylistic difference, I guess.
David, 30 seconds left, but you mentioned the tax cuts. That's essential now, I would think, in extending these tax cuts, or else we're going to get a double whammy on our economy.
No question. It's absolutely essential, and the only thing I would say is you probably have to do even more than that. The markets did not price in just an extension of tax cuts. They priced in that plus some additional tax cuts. That's what the voters are expecting as well. So that's a big question mark over us as well, Tony.
David Bahnsen, always great to talk with you. Thanks so much for joining us and providing some insight to this very, very important issue.
Thank you so much for having me.